Investing in a market tracking global fund can be a compelling and attractive long-term investment strategy for investors. After all, historically speaking, backing the smartest minds on the planet has played out pretty well over time. And behind that simple idea are many different funds, all claiming to track the world. But which one actually does it best? Well, I've spent many hours researching and comparing a number of these different funds, and the results really did surprise me. One of the popular funds that many people talk about and actively invest in was actually the worst performing and the second most expensive. So today I'll share that research with you, where we'll discuss everything from asset allocation to market pricing, fees, performance, and much more. But before we get started, this video is for educational purposes only and is not financial advice. Nothing within this video is an investment recommendation. Always do your own research, and when investing, your capital is at risk. When you start out investing, it can be difficult to know what to invest in. Which collection of high-performing stocks are going to be the ones that can take you through to an enriched retirement? But data from Morningstar actually shows how difficult it is to pick individual stocks, with only 38% of investors outperforming the market. And there are other studies that go as far to say that only 10% of individual stock pickers outperform the market. A slim set of odds, let's say, which leads to a growing argument that individual stock picking is simply a loser's game. That's where passive, low-cost, market-tracking funds come into play. Or in the case of this video, global funds. Because instead of trying to handpick the winners, which is inherently difficult, instead you'll just buy into a slice of the planet's total investable market with just one single investment. No need to pick individual stocks and spend hours siphoning through financial reports, and instead you can spread your risk across thousands of different stocks across the world. But here's the catch: there isn't just one single global market index. In actual fact, there's a handful of them, which are all very much nuanced and slightly different. The first one being the FTSE All World Index. Launched in the year 2000, it actually captures about 90% of large and mid-cap stocks across both developed and emerging markets. The second index is the MSCI World Index. This index was launched in 1986 and captures 85% of large and mid-cap stocks, but only from developed countries, excluding countries like China, India, and Brazil. Now, comparing the performance of these two indexes side by side from 2004 to mid-2024, if you could invest directly into the index, a £10,000 investment would have grown in excess of 600%, with the MSCI World Index edging ahead just slightly, by about 2% or so over the duration of this investment time horizon. But that's not the full story here, because you can't invest directly into an index. You have to invest into something called an exchange-traded fund, which has been put together by a fund manager to track the index. And the fund that you choose and how much it charges in fees and how it defines its asset allocation and overall how it's managed could have a huge effect on the long-term value of your investment portfolio. But there's one more, perhaps lesser known index that's worth knowing about, called the MSCI All Country World Index, or ACWI for short. Think of it as the MSCI World Index, just with the addition of emerging markets. It's been around since 1990 and covers roughly 85% of the investable market with 2,509 constituents. And this was the first bit of research that really started to capture my attention, because when compared to the MSCI World Index, which was the better performing out of the two when compared to the FTSE All World, well, actually, the MSCI All Country World Index has actually outperformed, to the tune of about 10.2% over the past 25 years. That might not sound like much, but over the period of a couple of decades, that could really compound into a sizable amount of money. And that's worth remembering for later on in the video when I start to show you the impact of the popular Vanguard FTSE All World Fund. And you may be surprised to know that it's not the best performing one out there. And before we look at comparing multiple exchange traded funds, all of which are available on Trading212, who I've also partnered up with for today's video. Now, Trading212 are a commission-free investment platform who I've been using for the past 5 years now. And they have a range of different investments, from global equity ETFs and thousands of different stocks on their platform that allow you to invest completely tax-free through their stocks and shares ISA account. Now, to help you guys get started, Trading212 have offered all of my subscribers one free fractional share valued up to £100 when you click on the link down in the description below, or if you scan the QR code here and open an account. Or alternatively, if you have opened an account within the past 10 days, if you enter the promo code Mitch within the app, you'll also be able to qualify for that one free fractional share. Thanks again to Trading212 for sponsoring this video. Okay, let's start off by talking about the two ETFs that track the FTSE All World index. We've got the Vanguard FTSE All World with a ticker symbol VWRP and the Invesco FTSE All World with the ticker symbol FWRG. Over the past 12 months, they've performed almost identically, both up around 16.5%, only about a 0.04% difference between them. And on a year-to-date basis, it's a similar story, which is kind of surprising because the makeup of these funds are actually quite different. The Vanguard FTSE All World ETF is what I would describe as the most pure play tracker of the FTSE All World index, with a total of 3,625 holdings, compared to that of Invesco's fund with just 2,388 holdings. Despite the difference of about 1,200 stocks, the performance of both these funds has nearly been identical. And that's probably no surprise because they're both market cap weighted. This means that the higher the market value of a given stock, the more weighting it will be given within the exchange traded fund. Let me give you a little bit of an example. Comparing the top 10 holdings of these funds side by side, you can see the top 10 holdings for Vanguard makes up about 22.86% of the fund's exposure, whilst for Invesco, those top 10 make up 23.16%. Tiny differences, but the asset allocation of these top 10 holdings ultimately have an impact on the performance of the fund, especially when you consider that the Magnificent Seven made up for over 50% of the US stock market gains in 2024. And here's an interesting stat for you, particularly when I did a little bit more digging into the Vanguard fund, in that over 2,500 of the holdings within that fund have less than a 0.01% allocation, making up just 2.5% of the fund's total assets, hardly making a dent for such a large number of holdings. What's important to all investors though is fees, and Vanguard, whilst they have actually reduced their fees on this fund as at the 7th of October from 0.22% down to just 0.19%, it is actually still more expensive than the more competitive Invesco fees for their fund of 0.15%. So Invesco wins out in this case on fees and performance, but Vanguard arguably still wins out when it comes to investor trust and brand loyalty, with over £20.3 billion in assets under management versus the £1.5 billion of assets under management for Invesco. Okay, so that's the funds that track the FTSE All World Index. Now let's talk about some of the funds that track the MSCI World Index and the MSCI All Country World Index, and then we'll compare them all together. So the three funds that we're going to be looking at now are the iShares Core MSCI World with the ticker symbol SWDA, the HSBC MSCI World with the ticker symbol HMWS, and the SPDR MSCI All Country World ETF with the ticker symbol SPYY. The SPDR All World Fund has actually outperformed year to date with returns of 11.81%. Certainly not a landslide victory, but it is enough to kind of make you sit back and think about your investment portfolio, when compared to that of HSBC's returns of 10.57% and iShares at 10.25%. What's contributed to that outperformance, you might be wondering? Well, the SPDR fund has actually more holdings within it, at 2,219, compared to iShares and HSBC that are more around the 1,300 mark. Now, more holdings doesn't necessarily mean better performance, but in this case it does mean more diversification, and more diversification appears to be paying off, at least year to date anyway. Interestingly though, it could be more down to the fund's overall asset allocation, where with the SPDR fund, the US actually features less heavily, whilst it makes up nearly 70% of the other two funds, making them fairly concentrated. I guess this leaves more room for the SPDR fund to actually invest more in different countries around the world. Of course, with the addition of emerging markets for this index, which we spoke about a little bit earlier. The top 10 holdings of each of these funds have slight variations in them too, where in my mind, I guess I would have expected perhaps the funds with the bigger US weightings to have performed better year to date. But I guess I've been proved wrong. But I guess this could be down to the dollar devaluation which we've seen so far this year. Rather surprisingly, from a fees perspective, the SPDR fund is actually the cheapest at 0.12%, followed by HSBC at 0.15% and iShares at 0.2%. So for the MSCI indices that are being tracked, SPDR certainly takes it on fees and performance. But how do all of these funds stack up when we compare them against each other? Well, here's an overview for you where you can see the SPDR MSCI All Country has quietly pulled ahead in performance, which I guess makes it slightly more attractive considering it has the lowest fees too. Vanguard certainly holds the top spot for assets under management, which is obviously good for investor trust and brand reputation, whilst iShares and HSBC are a little bit more concentrated to the US market, which historically has outperformed over the past couple of decades. But with that all in mind, here are some final things that I'd be thinking about when selecting some kind of global index fund tracker. First, do you want emerging markets to feature within your investment portfolio? Admittedly, emerging markets have been a bit of a laggard in terms of performance over the past 5 years. But when added to the portfolio, they've actually slightly contributed to further gains. Second, the US makes up a bigger chunk of the funds that just track developed markets, making them ever more concentrated. And with valuations historically high for the US market right now, that might be just something for consideration. Although it is worthwhile saying that these are market-weighted indexes, so the asset allocations would move around if in the instance that valuations would come to a head or some kind of market crash were to occur. There is also a final consideration here in that if you're more bullish towards US stocks, then you may have a bit of a disposition to just track the US market, which you can do so through some kind of S&P 500 tracker fund. And that may be a little bit more optimal for you and your investment strategy based on what you think's going to happen in the future. With all things considered though, whether you prefer Vanguard's size and reputation or SPDR's better performance and lower fees, by owning a slice of the world, you're backing the brightest minds on the planet to continue to drive growth, profit and cash flow, which is actually a story that historically speaking has ended pretty well over time, regardless of which global fund that you end up choosing. If you did find this video useful, then be sure to subscribe to the channel and also let me know down in the comment section below which global fund that you're investing in. And finally, to find out what I would do if I had to start investing all over again, then be sure to check out this video next. With that being said, I'll see you over in the next one.